A couple of weeks ago, Congress passed the One Big Beautiful Bill, and it was signed by President Trump. How does that impact retirees and seniors? In this video, I want to cover the top 5 items that I think are important to retirees and those near 65. My name is Yaku Yordan with Riverchase Wealth Management. Let's get into it. Okay, so the top 5 things that I think are important to retirees and to seniors are: 1, extension of the tax brackets from the Tax Cuts and Jobs Act. Second thing is extension of the standard deduction format. We'll take a look at that in a second. Continuation of the senior deduction, which is an additional deduction on top of the standard deduction. Saying deduction a whole lot. I'm going to explain this in a second. Next, big change in the bill is the Enhanced Senior Deduction, which is the possibility of a $12,000 deduction for those married filing joint who are over 65. And then the last thing that I think is important is the ability for non-itemizers to be able to take some charitable deduction. Lots of other things in this bill, but if you're retired, probably not worried about whether or not your tips are getting taxed, whether or not your overtime is getting taxed, and you probably don't have enough in state and local to take advantage of the changes on that side. So again, that's why I want to focus on just this top 5. So let's get into the computer and take a look at some of these items. All right, so we're going to start with extension of the tax brackets under the Tax Cuts and Jobs Act. So originally under the law, in order to get it passed under reconciliation, some of the tax changes had to have an expiration date, and that was personal tax brackets. So all those bracket reductions that we received under the TCJA in 2017 had an expiration date of the end of 2025. This graphic shows the tax brackets under the TCJA on the left-hand side, and if we had reverted to the brackets that existed prior to the TCJA on the right-hand side. Well, you can see on the left-hand side, we've got 10%, 12%, 22, 24, 32, 35, and then 37. And on the right-hand side, 10% bracket as well. The 12 would have bumped up to 15. The 22 would have bumped up to 25. Part of the 24 would have fallen into the 28% bracket, and part of the 24 would have fallen into the 33% bracket. So that's a pretty big difference right there. And I think if you're talking about Roth conversions, there is big opportunity right here to take advantage of the extension of the TCJA brackets. Above that, 32, 33, not a big difference. There's actually a little bit of income under the TCJA at the 35% bracket that would have been in the 33 if we had reverted. But then you can see that's a very narrow 35% bracket. Above the bars that you can see here, we get into the maximum brackets, which is 37% under the TCJA and 39.6. You can see that the 39.6 would have kicked in a lot sooner if we had reverted, and so that would have been very expensive for very high income retirees. Okay. So what does that actually mean in terms of what you're paying? What this graphic shows is gross income along the bottom here. So 50,000, 100,000 stepped up by 50,000 all the way up to $500,000. And then between the brackets, what the savings is under the TCJA extension versus reversion. So at $100,000, you're saving about $1,800 from a tax bracket perspective. 150, it steps up to $3,750. By $200,000 in income, we're at $5,000. I should mention that this is gross income. This is not taxable income. So this still assumes that you have a standard deduction, and this is prior to some of the other changes that I'll discuss. This is just isolating the extension, the TCJA versus reversion. At $400,000 in income, so now we're doubling, we bump from $5,000 in savings up to $16,000. So you can see that it is pretty progressive. This is a function of the prior slide where we talked about that 24% bracket kicking into the 28 or the 33% bracket. So it makes a pretty big difference at that point. By $500,000, it's about a $23,000 savings. So fairly significant across the board here for retirees in terms of the extension of those brackets. So the next thing I want to take a look at is the extension of the standard deduction model. So prior to the standard deduction model, prior to the Tax Cuts and Jobs Act, there was a combination of standard deduction and a bunch of exemptions. And Congress at that point basically said, look, most people don't want to do the tracking of the paperwork to do some sort of itemized deduction. Let's just simplify matters, increase the standard deduction, and get more people to take the standard deduction. So What you can see here, first of all, we're looking at 2026. Why 2026? Because TCJA is current law. It was going to sunset at the end of this year. So if it were to sunset, we have to take a look at 2026 to see what the differences are. What I've got here is a married couple. They are under the age of 65, got about $100,000 in IRA distributions and $50,000 in Social Security. You can see because of this IRA distributions, about 85% of their Social Security ends up being taxable. So they end up with an AGI of about 142.5, which you can see right here. And then this is what I'm talking about with standard versus other deductions. Under the TCJA, if it had sunset, the standard deduction would drop to $16,500. And then there would have been exemptions available to these individuals of about $10,600. That results in taxable income of about $115,000. Under the past law, we're going to inflate the standard deduction for 2025 into 2026. It's assumed at 2% to end up being $32,130, which ends up at about $110,000 in taxable income. Couple that with the differences in those brackets. If you remember from the earlier slides, 12% becomes 15%, 22% becomes 25%. Total taxes, if the TCJA had sunset, for this scenario is about $17.7 thousand versus $13,700. So it's about a $4,000 difference in tax for this couple. Pretty significant. Okay. So now let's back it up into 2025 and look at something that is effective for this year, and that is the standard deduction. Now, again, currently we are looking at, since we are operating under TCJA, $30,000 in standard deduction. The new law changed the standard deduction and they increased it by about $1,500 for this year. So standard deduction, even without the sunsetting, has increased slightly to $31,500. What if, however, these individuals were actually over the age of 65? If we indicate that they are over the age of 65, then they are going to get an additional standard deduction added to that amount. So we were at $31,500 and now we're at $33,200. That's going to step up to $34,700. So what's happening here is for a married couple filing joint, you get an additional standard deduction for each individual who is over the age of 65 of $1,600 for a total of $3,200. If you are a single filer, that amount is actually $2,000. So slight marriage penalty in there, but you still, on a joint basis, get the $3,200 deduction. So again, good thing that this was extended, increases the amount of the deduction that is available. Now, the next thing that you're going to notice that's going to sneak in over here is a $12,000 deduction. This is the new Enhanced Senior Deduction. It is $6,000 per person over the age of 65. So Trump had campaigned on the idea that Social Security should not be taxable, but because of the way that the bill was passed through reconciliation, he could not actually make Social Security non-taxable. What he could do, however, was to add a deduction that is available to those individuals that are over the age of 65. And they settled on a $6,000 deduction per person over the age of 65. So that's where you get this $12,000 deduction. Makes a pretty big difference in the taxable income. What you can see here, $109,300 under existing law, or previous law, I should say. And then under the law that was just passed, we're now at $95,800 in taxable income. Makes a pretty big difference for this couple, from $13,800 in total tax due to $11,000 in total tax due, and it pops them down into the 12% bracket. One thing that's important about this $12,000 deduction is it is available to you even if you itemize. So if you do get to take advantage of some of the additional enhancements to itemized deductions, you can still get this enhanced senior deduction of $12,000. Of course, to make this more palatable from a budget perspective, they had to limit this deduction in some way. And so what they had to do was to add phase-out limitations on this. So the phase-out for this on a married filing joint couple starts at $150,000, and the phase-out range is $100,000. So by the time your AGI hits $250,000, this deduction will shrink to zero. If you're a single filer, that phase-out range starts at $75,000 in AGI, and it is fully phased out again over $100,000 at $175,000. If you currently are married but filing a separate return, it is important to note that this deduction is not available. It is explicitly written into the law that the filing status of a married couple has to be married filing joint in order to be able to get this deduction. So the last thing I want to talk about is charitable deduction. So a few years ago, the law allowed for non-itemizers to take a very small charitable deduction. At the time, it was limited to about $600. That provision expired, and for most individuals, because the standard deduction has moved up so high, it has been very difficult to get the deduction for making a charitable contribution. So what the One Big Beautiful Bill does is it allows non-itemizers to take a charitable deduction. For married filing joint, it's up to $2,000. So it is for cash contributions to qualified charities, and I'll show you just real quickly how that works here. So on the left-hand side, this is just under the TCJA. On the right-hand side, this is the new law. We're making a $5,000 contribution. This is under itemized deductions over here, but we're not going to itemize. So what happens is we get the standard deduction for charity under the new law of $2,000. And so in combination with our $12,000 enhanced senior deduction, we now get $14,000 in total deductions, once again, reducing our taxable income. Now, question is, first of all, I should note that this provision is effective for 2026, so you still will not be able to get that charitable deduction unless you itemize for 2025, but pushing into 2026, that is going to be available. One thing that I should note is if you are eligible for qualified charitable distributions and you have an IRA, you're over 70 and a half, you have an RMD, you're not using it all. Even though there is this deduction, I would suggest doing this via a qualified charitable distribution. Why? Because that happens above the line and it impacts and reduces your AGI. Whereas this new standard deduction for charitable contribution happens below the line, which does not reduce your AGI. Why does that make a difference? If you're very close to, for example, your Medicare premium limit, possible that taking that deduction as a QCD might put you under the line where you don't experience that increase in Medicare premiums. Obviously, AGI is relevant for a whole lot of other items as well and phase-out ranges. So it probably will make more sense for you to do that as a QCD instead of taking advantage of this new standard deduction. But for everybody else, if you are younger than age 70 and a half and eligibility for making a qualified charitable distribution, you will have this ability to take a charitable deduction for a cash contribution, even if you do not itemize your contributions. So those are the top 5 things coming out of the One Big Beautiful Bill for retirees and seniors. If you have any more questions or would like to find out more about working with us, please look down in the description to find our information. My name is Yapi Udon with Riverchase Wealth Management. Thank you for your time.